Truly speaking, if you had purchased Bitcoin back in 2009 or latest 2017 when Grant Stephen made this video and still hold it up to today, I guess you would have been among the richest crypto millionaires in our society today.
If you've looked at the internet in the last few days, I'm sure you've seen an article out there that says if you had bought $100 of Bitcoin 7 years ago, you would have over $75 million today. And Bitcoin is a topic that people get so opinionated and so heated over. People either love it or they fucking hate it and they think it's the worst thing ever. I'm somewhere right in the middle. I mean, I don't really have a preference for or against Bitcoin, so I'm gonna be sharing my thoughts and my unbiased opinion about whether or not Bitcoin could be a good investment.
Or better still, if you had purchased Tesla stock during the time when this young teenager purchased when he was still in high school, that was 2019, and still hold it up to today, I guess you could have been counting for thousands of dollars in profits.
I invest almost all my money, for better or for worse, in Tesla. Yeah.
Wow.
Yeah. Almost all.
How long have you been doing that for?
2011, maybe. Yeah.
2011 Tesla would have been, I don't know, $20 a share, right? $4.46. That means that on those early investments, you got like a 20,000% return.
All the same, right now, is it better to invest in cryptocurrency or better still the stock market? So this question of whether is it more preferable to invest in cryptocurrency or better still the stock market is one question that most of us had obviously thought about in the past. And we just assume and say, well, I'd rather buy X amount of Tesla stock or X amount of Apple stock because they'll be doing pretty well in the recent time. In context, there's no single investment that's regarded as the best investment. You could be sitting on a stock portfolio of thousands of dollars today, and the very next moment, the stock begins to decline in value. You know you cannot control how the market fluctuates. Today, it moves in your favor, and all of a sudden, boom, your stock portfolio begins to rise, and you are all cashing out in profits. And the very next moment, it will look as if the whole world is all against you. Your stock portfolio begins to drop, and it looks as if you made the wrong choice of stocks to purchase. Or even in some worse conditions, it could be due to some broader economic crisis, like during the period of inflation and recession, where there's a general decline in productive activities in the economy. All this can all account for unfavorable moments in the market. That's why it's very important for you to take some precautionary measures when investing in any sort of investment, both cryptocurrency or even in the stock market. So with that in place, I'll be listing some of the measures anyone that is already into investing or has a plan of investing in the cryptocurrency or even the stock market can take, as these measures can help you to mitigate losses. And finally, I'll be wrapping up this video with my day suggestion. Between cryptocurrency and stocks, which is the best choice of investment based on some certain categories and criteria. So if this is your very first time on this channel, you can make my day by simply clicking on the red subscribe button. It really motivates me a lot. And if you enjoy videos like this, make sure to click on the like button. And if you have any opinion pertaining to this video, don't forget to drop your comments in the comment section. I'll try as much as possible to respond to each and every one of these comments. And with that in place, let's dive right into the video. So the obvious difference between stocks and cryptocurrency is the fact that stocks represent a fractional ownership of interest in a business. Imagine you own a small percentage of the company. When you buy a stock, you are essentially buying a share in that company. It's like you owning a piece of that business. Companies make their money through their operations. They often publish their yearly earnings, which is their profit, in order to attract potential investors. Any potential investor can have a share of the company's profits by simply purchasing a certain percentage of the company's stock. Higher stock can equate higher profit for an investor, but in some cases where the stock is volatile, example, when the company performs poorly that year, you may end up losing your money because the stock prices will drop. That scenario often equates higher stock, higher risk. Large market cap stocks are less volatile compared to penny stocks. Large market cap stocks are stocks that belong to the well-established companies, usually in billions of dollar market value. These type of stocks are less volatile in the sense that they already have a strong market presence. Of course, most Apple users have undoubted faith that the next iPhone that Apple are going to be releasing will live up to their expectations. With such a high trust from their customers, when transformed into the market, that will make their revenue to be stable over time. In terms of price fluctuations, the stock prices of most of these companies tend to experience a moderate fluctuations, in the sense that most investors and market analysts track down most of these companies' revenue, leading to a moderate demand. A typical good example of this type of companies would be the S&P 500. On the other hand, penny stocks belong to companies that are early in their life cycle. Penny stocks tend to be more volatile as economic crisis or even economic downturn and less financing can affect the company significantly. What makes penny stocks a great opportunity for investors is the fact that most millionaires buy shares into this company when they are earlier in their life cycle. What they do is that they first analyze the likelihood of this type of companies making it to the top, and with enough conviction, they go ahead and buy a huge share from these companies. All the same, large market stocks offer stability, while penny stocks are more riskier due to their smaller number and their unpredictable behavior in the future. Any investor should first analyze their risk tolerance and their goals when investing on either of these two types of stocks. On the other hand, cryptocurrencies are more like digital coins or tokens that only exist in the internet world, and their prices are mostly driven by people's speculation of its future value. People buy and sell all these cryptocurrencies on crypto exchange platforms, and among all the whole cryptocurrencies that are valuable, Bitcoin is one of the most popular of them all, and at the time of this recording, Bitcoin has a current market cap of over $1.3 trillion. Think of cryptocurrencies as a new kind of money that is not controlled by government or bank or even any central authority. That's why it's often regarded to as a decentralized form of currency. While stock prices is often attached to the company's performance over a particular period, in the sense that if the company performs very well, their stock prices is likely to go up. On the other hand, cryptocurrencies are not attached to any asset or even any cash flow, but it's only affected by people's speculation of its future value. If people reason that this value of so particular crypto will go up, they tend to purchase more and thereby increasing the prices of such cryptocurrency. From the current market condition, it's revealing that more people are buying and stocking these cryptos, hoping that the same quantity of crypto they have bought today will be valued for more in the future. From a financial perspective, such a scenario is often referred to as the greater fool theory of investment. In fact, we all are investing today, hoping that the same money that we put into investment on a particular asset will be valued for more in the future. Number one rule that you must observe before investing, either cryptocurrencies or even in the stock market, is the fact that you should never invest more than you can afford to lose. You know, the stock market or even the market world can act very funny, but it's very important that you take this as a number one rule. Don't invest more than you can comfortably lose. Essentially, even before investing, you should first analyze your risk tolerance. How well can you handle unfavorable market conditions? In the sense that if the market should crash, or even if your stock portfolio should just from 100 drop down to 0, how well can you handle such a situation? Alright, so another important measure to observe is the use of dollar cost averaging. So some of you are already familiar with this concept, but by definition, dollar cost averaging is an investment strategy that involves you buying a fixed amount of security or even an asset at a regular interval, regardless of the market prices at that moment. So by this, the investor can lower the average cost of their investment and also avoid buying at high prices. So what dollar cost averaging is advising is that you should make a small recurring purchases of stocks or cryptos on a set schedule. It can be weekly, monthly, or even yearly, depending on your investment goals and the level of your income. Okay, so let's say you decide to invest $100 monthly on a particular stock or crypto. Regardless of whether the prices are high or low, you consistently invest that same amount every month. So what actually happens is that when the prices are low, your $100 buys more shares, and when the prices are high, your $100 buys few shares. Over time, this pattern of investing will help you to reduce the impact of market fluctuations on your portfolio. A good reason why buying regularly, even in up and down markets, is the fact that you tend to accumulate more shares when the prices are low and fewer shares when the prices are high. So this strategy will help you to reduce the risk of making a huge investment all at once, especially when the timing is not ideal, mostly during unfavorable market periods. While dollar cost averaging can help to reinforce the practice of regular investing, in the long run also, it can help to build a sustainable stream of wealth. Also, investors with low risk tolerance, this type of investing can help you to ignore the short-term volatility of the market and remain focused on the long-term goal of your investment. And finally, on the measure that you should observe before making any investments is the fact that you should make your own individual research and stick to fundamentals. Of course, no one truly knows the best performing stocks or cryptos to purchase or perfectly predicts how the market will play in the long run. We all are relying on past data and assumptions to predict how the market will turn out to be. So with this in mind, when investing on cryptos or stocks, it is important to stick to the core fundamentals and principles, and also your overall goal on why investing, rather than focusing on the short-term trend of the market. In analyzing a particular stock, this will involve you assessing the company's financial health, their profitability, and also their earnings. Also, don't forget to analyze their growth prospects in the long run, their market shares, and also their expansion plans. And lastly, like I've earlier discussed, rather than going after the market hype and the market noise at that moment, place your investment decisions on the fundamental analysis of the company, as companies with strong fundamentals tend to be resilient and more stable in the long run. So with a clear understanding of all these measures, what then is my ideal suggestion between investing on stocks and cryptos? So let me say this for a fact: if your goal of investing is short term and you're more concerned about making profits as quickly as possible, I recommend investing on cryptos, because cryptos tend to have a high volatility. Over the past decade, both Bitcoin and Ethereum have outperformed the S&P 500. Don't be too happy about it, because past performance does not really guarantee of how the future results will be. So like any other thing that have advantage, it's also the other side of the coin. So while cryptos have a high chance of making an investor rapid gain due to the high volatility, if reverse is the case, an investor is exposed to greater risk, holding to the fact that there are many meme coins skyrocketing all over the crypto space. So analyzing the perfect crypto to invest is a whole new work altogether. A perfect opposite of the crypto will be stocks, probably for long-term investors. So stocks are characterized with less risk and compound return. Looking back at historic data, the stock market has consistently provided positive returns. So while there may be occasional downturns, the overall trajectory for stocks has remained upward. Depending on your goal for investment, you can either invest on the stock market or on cryptocurrencies, or better say, you can diversify your portfolio of investment between stocks and cryptos. So I hope this video serves for its purpose, and if you're okay with it, you can extend your thumb a little bit and tap on the subscribe button. And until next time.